Rocco, Rocco, our favorite rock. Rocco, 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 our favorite rock. Rocco, 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 our favorite rock.
Entertained? Are you not entertained?
Hello. That was I mixed it up, tried a new part. Oh God. How's it going? So figure there was a few topics I wanted to cover. Obviously it was vacation week, so I didn't do a normal stream this week. Yeah, I was in wine country with my friends, which is funny because then we don't go to wineries, we go to the breweries and the distilleries out there, and then hiked a little bit. And then I got bronchitis, which is fun. I've been dealing with that. So my voice is all jacked up still. That's why I'm not really doing lives with other people much at this point. So, but I have to go back to work tomorrow. Anyways, all right, I was going to cover Nike a little bit as the video showed. So basically, unless you lived under a rock, you saw what happened in Nike. So Nike had earnings and it got obliterated. Now, I've been pretty bearish on Nike for some time, and I've been following it a long time because I don't know, dividend investors have always, I think every dividend investor, this is on your radar, because as a dividend growth investment, it would have done well for you over long periods of time. But here we are in the present day of 2024 talking about it. So this year I did short the company or did puts on them last earnings, and I did pretty well because I don't understand, and we'll get into partially why it's valued so richly and what's the problems that I see. And you can figure out if you want to buy it yourself. Okay, you're grown up. But you can see they got obliterated worse than this one, or last earnings, which I'm trying to remember when. I think it was this dip. Yes, because I remember it ran up before earnings. And I'm like, why are people so enthusiastic about Nike at this point when interest rates are so high and the company's nothing exciting about Nike's coming out product wise. So I thought it should perform poorly, and it actually did pretty well for me. That play would have done better if I did this one, but I've been busy with other shorts, which we're not talking about yet online. So let's look at like Nike. Okay, let's talk about its shoe companies, right? Because I saw a few people go, well, if you look at if you pick apart Nike's financials, they're growing really fast in Middle East, or their equipment business is growing rapidly. All this shit. Okay, let's get this down to the brass nuts. Nike's a shoe company. Nike is a shoe company. Nike's a shoe company. I don't know if you knew that. They live and breathe on shoes. That should be what you look at. Okay, look at their shoe business. Let's look at that. So I'm not going to talk about the other apparel. Fine. But this is about shoes, I think, is what Nike's problem is. So just to give you reference, this is like the growth estimates of the shoe business in North America. I don't want to talk about international. Let's just stick to something that's simpler to understand. So the annual change in the shoe business from like now, next few years, you're looking at, they're estimating 7, 9, 10, 9, 7, 4% growth per year in the shoe business, US footwear market. Okay, not just athletic, but all shoes. So that's kind of your tent pole. So just think of that. So another piece to tell people, why is Nike so richly valued? I would propose it's because they have had a brand moat, which, and I don't think moats are rarer than you think. And I've covered this in another video, but in this case, I do. Nike has up to this point had a moat in their branding, and why? This study, this is a semi-annual study of teens and brand awareness and stuff like that. Nike always, for like the years I've followed this, Nike's always the top scorer in footwear and apparel and clothing and stuff like that. So there's something there. Now, a lot of the other brands come and go. If you look at these over the years, but Nike footwear scores highly on branding. Okay. So, but this doesn't factor in this year. This is last year's survey. So, okay, there's something there. But I've said this before, you have a moat until you don't. Okay. Right. Moats are not eternal. Company has a moat and then it's gone someday. Like I say, Adobe doesn't have a moat, right? I don't think they do. And we'll see. So here's that piece. Okay. Why is Nike richly valued? Okay. This is part of it. Okay. There's something here. So now if we go, here's the transcript from the call where they got obliterated. But if you just search guidance, so I mean, you can go, if you have like a Bloomberg, you can see their guidance, but reduced guidance fiscal 2025. Okay, this isn't good. So they reduced their guidance. We expect first year gross margins to be in line with full year guidance. Okay, so that's not the worst. Update our guidance down mid-single digits in the full year for sale. Bam. There's your annihilation. Okay. And then this part, I think we've softened our outlook on Greater China. So I would say the biggest things that we're bringing, they were pushing the narrative of direct to customer sales, which are a better margin business for them growing, which it's not been growing effectively. It has, then it's not. And also they pushed the China story, but now here's a pretty strong statement from them. China's not working out and growing like they want it to. So now that's gone. Okay. So this is a lot of deflating problems with Nike. Now let's not, the reason we're going to do this is there's a lot of people I think that just jumped into Nike because it's cheap. Okay. As soon as it dropped 20%, people just bought it. I'm telling you. And I don't think they looked further into it. And this is like a day's worth of just evaluation. And this could make you think, do I really want to get into this company? Or do I need to wait for something to happen before I get into it? Do they need to show you something? Not just that it's a cheap perceived stock. Okay. It's cheap is your opinion. It's not a fact. Just because it dropped 20%, it can drop another 20%. Okay. Okay. So guidance management it's all negative, running down. Guidance is bad. So how did we get here? Another piece of the puzzle. So during COVID, so a few years ago, they had this idea. So they were going to cut a lot of the retailers loose. They were just going to cut them. And they were going to go direct to customers, and they were going to do their own wholesaling direct through their own website. So they're like, we don't need Foot Locker. We don't need all these retailers. We can just use our own website, direct sales. We make more money, better margins. Part of that they probably knew because their sales weren't growing. They grow 1% to 3% per year. So they're not a growing business anymore. So how do if you can't grow the top line, maybe you can improve the bottom line. So this was their attempt to do that. So basically they pissed off all their, retail partners. Number one. Number two, this idea was terrible and they weren't ready for it. They admitted after when it failed, they were not ready for this. On the back end, their inventory started to swell. They just were not ready to take on this burden. So if they wanted to do this, they could have reduced their inventory, right? Cut back on their production of their products, scaled it up as their business group, but they didn't want to do that. So they didn't scale back their products. So you saw during COVID, their inventory, go look at their financials, their inventory exploded. It's a complete botched job by management. I think I've talked about this before. So they were trying to do this. but they weren't dealing with the problem over here. So all of a sudden they had a $10 billion glut of inventory, which they then had to sell at like huge markdowns and take losses. So they got punished for that between 23-ish. It's botched after botched idea like this. So they've been a struggle bus for a long time, right? This was a bad idea, I think. And they probably agree because they've pulled back from this. They're realizing they need those retail partners. And more importantly, here's the other thing. When you pull out of those retail partners, what do? You open up shelf space for competitors to move in, right? Because the stores don't go bankrupt. So if Nike pulls out a Foot Locker or Champ Sports or whatever your local shoe store, okay, well, who has room to go in? Well, guess what? On and Hoka are around the corner, and Decker shoes, which we'll get into later. Your competitors now have more shelf space. Another big problem with their idea. So they were shooting themselves in the foot to save a few pennies. This whole idea. Another problem. Okay. Gil, if you keep spamming my comments, I'm going to time you out. Like, it's really annoying. So we look at Nike's quarterly. Okay. It's still bad. I mean, we already talked, you can see revenue flat, down. Direct sales here, they were trying to tell you direct revenues were going to be the future, down 8%. So it's not working, like we said, the direct sales part. Wholesale revenues up a little bit. So, and then you come down, where's my show? Nike direct revenues. Let me get the shoes. Oh, shoes are next. Okay. So here's their filings. To me, it's about like, let's look at North American footwear. So let me zoom in. Tell me to zoom in if I forget. So North American footwear down 6%. I mean, this is Nike, you guys. Nike. And you saw the projections in the footwear in North America. They're not negative, from 5 to 10% growth per year in the footwear industry. So just to keep their market share, they should be growing 5-10%. So they are losing. I don't think anybody I saw talk about Nike. They are losing market share. North American footwear. I'm not gonna like forget about the international for a second. They're losing market share in North America. So, and you all know who's taking their lunch. There's two companies that are taking their lunch money right now. Okay. So like that is why Nike's getting obliterated, and this is why they deserved to get that big obliteration on their quarterly earnings. So to say it's a cheap stock, I would disagree with you. Cheap would imply it was an unfair hit by the market on their earnings. I would say it was very justified, that hit to their stock price. Okay, now somebody had said equipment. I literally saw someone say, "Oh look, but equipment is growing rapidly." Okay. It grew 47%, but what is it like? It's an error. It's a rounding error on their friggin' financials. Don't worry about that. It's a shoe company, okay? Another thing, someone said compared them to Lululemon, which I thought was hilarious. Lululemon is an apparel company, okay? Nike's a shoe company that also sells apparel, but you can say, okay, well, the apparel is this percentage of their income. Okay, but like the core of Nike is run by the shoe, and it still is, and they're failing. So here's that. Okay, so here's who's beating them. They're taking their lunch money. Decker and on are taking Nike's lunch money. Okay, how is Nike gonna reverse this? That's what you need if you're gonna buy this. How are they gonna reverse this? Because I have Hokas. I love Hokas. I think they're very innovative and comfortable shoes. No, remember, North American shoe sales, Nike's down. So let's look at here's Decker. So I can go to Hoka. Hoka brands growth 27% this quarter. Okay. So I'm because I don't want to pull out the other stuff because it's like different shoes. We can look here. Hoka net sales increased 34%. Gross margin 56%. I mean, these are insanely fat. So huge increases in sales. amazing gross margins. Okay. So they're not losing business. They're friggin' surging. I can go to On. Here's On. Net sales. There's not a lot here, but okay, where is it? Right here. Net sales Americas. Right here. Hold on. So you can see basically, give or take, Hoka and On are growing 30% right now. 30%. Their shoe business, their running shoe business in North America. Nike's going down 6%. Okay. So Nike's losing market share to these people. And it's not that on an obvious. I mean, these are innovative shoes. You could think they're ugly, but they are an innovative design, like the tread on the On-Ons, that type of design. It is innovative. They do look nice. And they've worked with retailers, I understand it, on their displays. I've been to 3 Dick's, and the Hoka and the On displays are almost all the front. Nike is relegated to like 3rd place status on their shoe displays. And it's just, I go look at the Nike. There's no innovative, interesting Nike shoe that I see. I guess you could say the Jordan brand, but nobody's really, I don't see people really excited about it. So you have a lot of problems if you want to invest in Nike. So like basically it comes down to like, how do you think Nike's going to reverse this? Like just the shoe, how are they going to stop bleeding North American shoe market share? I think that's, instead of looking at a global company, maybe that's the easiest way to look at this, because you can put the nuts and bolts together. I mean, there are some ideas like, I do not think the CEO is the person to do this. I think he got them into this mess. They need a new CEO, number one. I think Nike could do a few different things. They could really lean into, Hoka and On are expensive. They're like $180 shoes. What if Nike started coming, because inflation is a problem, people are crunched for money, come out with some really, really solid, like $50 to $75 shoes for kids and adults, and really make sure that put a lot of work into them, and just, I don't know, be Nike, put out a great product. What else they could do? Lean into the shoe stores, the shoe culture. Maybe have artists come in and do like signature shoes for the sneakerheads. And really dive into that scene more. I don't see them really. They could do more in that sector. That's another part of their business. They have a good advantage in that sector, definitely. Other than that, I don't know if they can go head to head with On and Hoka at this point. Like to say, oh, they can out innovate them. But it's kind of like, if you're going to spend $200 on a shoe, are you going to buy a Nike, or do you want something different, branded? It's like a car. Like if you're going to drop $100,000 on a car, would you buy a Buick at $100,000 or a Mercedes? Right? Branding at that point almost matters with the price point. So I don't know if they'd fight that battle. I think just a solid, cheaper shoe would be a great product for the market at this point, if they could do it. But they're in a bad spot. I don't think you can just get brand deals with a bunch of athletes to get out of this, which that I don't know. That type of business, is that even work in this modern economy? It feels like that was something from the 90s. The other problem, Nike was a business designed from selling to retailers. Right now they're bolting on a direct to customer business. Hoka and On started as a direct to customer business, and now they're scaling into retailers. So their advantages, On and Hoka, are starting at higher margins in a better business than Nike's doing the opposite. So competitively, this is better for them in the modern economy. Like if Nike was started today, they would have started as a direct to customer business, just like On. So this is a very, I don't think they'd have to do more things to me first for me to buy Nike. I'd be very hard pressed to buy this company. Their growth, like we've talked about, the multiple they sell at, and they they increase sales 1 to 3% per year if they're lucky. I mean, like health insurance companies grow faster than this. So just to give you some background, like this is a company struggling to find something, right? They're struggling really hard. And now they've got two competitors taking their lunch and they don't have a good answer for it. I think their shoe designs are stale, and I think they got caught on their feet, flat-footed on their feet. And On is like going right at Nike. They're like, we can do what you do, but better, right? Decker is different. They're just more of a complete shoe company. But On's going at Nike. Like they're exactly the same company. I think they're mimicking Nike, but they're doing it better, and they're succeeding. So if you're gonna buy Nike, I'd be careful. Like I'd be very careful. Like if you want to tell me you're gonna swing trade it because it's cheap, I don't think it's cheap. I think it's justified. I could see if you lose this brand moat identity, like if you lose that, if they go down in this survey this year, like this starts to put holes in their whole narrative of their brand image. And then I don't know what you hang this high valuation on at that point because they don't have the growth to back it up. This could keep dipping. Like this could be a $30 stock. I don't think people understand. This could very well be a $30 stock by the end of this year. More than 100. So I'd say be careful. Understand what this is. This is a company in crisis, but they don't say they're in crisis, right? Nobody wants to say that, but they should be in crisis mode. So we'll see how they react. Let's see if anyone has any comments. I think Nike will be a wait and see for me. I'm considering buying a few long dated options. They have some competitive risk. Yep, you saw it. Two companies are kicking their ass. Let me look. Nobody on mainstream investing media talks about the decline in revenue, just the increased competition. Yeah. I mean, they barely scratch 1 to 3% growth. And then like the segments, like that's what I'm like, how's their shoe business doing? And China, because that's what they were trying to tell people was where their path to profitability and success was. I think that I'm caught up almost. On shoes don't look good. They're like Chelsea boots. I mean, do they have lasting power? That design, we will see, right? So this isn't really a discussion of buying whether you buy on stock. I don't know. I don't own them, so I don't dislike them, but I think like I'm not like running to go buy on I think I'll probably stick with Hoka's, truthfully. I think they look fine and they work. Nike's purely a fashion brand that claims to be a fitness brand. I think many brands do different types of fitness wear better. Yes. I don't like Nike shoes. I've always found them kind of uncomfortable. Who? Oh, God. If I'm spending $200 on shoes, it's like going to be hiking or motorcycle boots. I'll take a balance to the day. Okay. Yeah. These will always be superior in my mind. Nike, classic tennis shoe. Oh, yes. Adidas has their place. I think they stick to their market pretty well. They know who they are. Did Paul buy Nike? It's right up his alley, right? Like, we have to name this where a stock gets hit 20% on earnings, and then people buy it immediately. Like, is this like bloodbath investing? I don't get it. It's just like people see a stock drop 20%, they call it cheap, and then they buy it. And they're now like LaFufu's analysis of Nike is the most hot garbage thing I've ever seen. Because all the things I just talked to you about, like go look at his video, see if he talks about any of that. Was this the one? Yeah, like or no, it's not this one. I don't think it was his main channel. Although he did talk about it there. Yeah, this one. This video is so dumb. This teaches you nothing about Nike, whether you should buy it or not. All the things I just talked to you about, he doesn't mention any of it. He doesn't mention On or Hoka once when it's obvious. You look at the statements of the management and the financials, you see what's happening. And he doesn't mention it. I don't think he even knows. And his analysis, like he spends half the video just talking about the brand deals. Who cares at this point? It's a shoe company. Yeah, like this is pointless. I can't. This guy is just laughable. But if you follow this, good luck. But this is hot garbage. So. Maybe Lulu could be unlikely, but yeah, like comparing Nike to Lulu doesn't make, like Lulu's an apparel company. Maybe they sell some yoga flats. They're not a shoe company. Nike's earnings are not based on track jackets. Okay, they're just not. Imagine if Paul and Jeremy teamed up with Stathis. Lots of people are buying Nike. Oh, that lots are. I feel like most influencers have at least discussed it. Yes, I think there's a new style of investing where maybe we will call it bloodbath investing. Something takes a nosedive 20%, and then everybody on YouTube talks about it, and then they buy it, or they say they buy it. And I think they talk about it just because everyone's aware of like this is shocking. So a lot of people there's a lot of eyeballs on it, and people want to know what happened. So there's a lot of eyeballs, so they all make content about this, and they all are experts on Nike, and then they all tell you they buy it. But this is a shitty investment. I think I'll just tell you, I think this is a shitty investment. Like I don't see the upside. They got problems. There's a lot of problems, and it's more likely to be $30 than 100 at this point, or it could just hover around 70s the rest of the year. Doesn't have to do anything. But I don't see what's the positiveness here? I mean, like I said, there's some things they could do, I think, that would be positive. They have not done yet. First thing, fire the CEO. He sucks. But and they're not in crisis mode, right? Number one, they're not in crisis mode. That's a problem. They should be. If On can start making styles like Lulu, they will take over. I mean, they've just gotten started. So when people like, maybe they have new designs for their shoes and like coming out. I mean, we don't know if they're a fad or not, right? It's such a new company. We will see. As Munger said, inverse, always inverse Paul Gabriel. Sorry. I'm dealing with bronchitis, as I said, beginning, which was just a great parting gift for my trip. When I had fun with the boys in friggin' wine country, got bronchitis over it. Fucking great. I've been looking at Decker. The pullback makes me want to get on board. All I can this breaks my heart because I so thought about buying this company. I really thought about it for a while, like in 2023. I just liked what they were doing. I like Hoka. It was basically like I liked Hoka's great shoes. And I'm like, oh, they also have Uggs. This is a good business. I should have just done it. And then it's just been an amazing stock, and they deserve it. Their growth is exceptional. 30%, like exceptional. And they have multiple brands too. So that like we're on you have to work. Okay. Yeah. Could on fade, right? Well, Decker has like 5 brands. So that's not as big a problem. Like they could have one of their brands suffer a bit and the other ones could pick up the slack. So different companies. But yeah, it's one of my regrets to not have bought that. On and Crocs were all fly by night. What does fly by night mean? I don't even understand. Lulu has shoes now. What do they look like? Let me see. Okay. I mean, I guess. I mean, this looks like Payless shoes. This is like crap. But I mean, yeah, yes, they do have. Okay, these are just like lounge shoes. I mean, LL Bean does stuff like this. So yeah, like they're not the same companies though. Jeremy said this stock is an easy money in the 90s. His last easy money stock was PayPal. Oh, yeah, yeah. PayPal was easy to the 90s, right? So is Nike. Sure. How are they going to get there? Negative 6% shoe sales in North America and guidance down for the year. And they said next year is not going to look much better than this year. Hope you feel that. Thank you. I think I'm getting there. Got a sore throat from the boys. Oh, God. I thought about too when Hoka got into golf and my mom bought the shoes. I didn't pull the trigger either. I know. I got my Hokas, early 23, wore them for running, saw some other people. I'm like, there's something here. Like these are really comfortable. And sometimes that's enough, right? Sometimes that like that's a Peter Lynch style investment right there. Elf contributed too, and Nvidia hasn't done much. Oh, okay. If Nike developed a shoe that kept president from tripping, it might boost their knee. Yeah, he's in rough shape. Okay, that's enough of this. I'm sure there's people that bought it. Good luck. I mean, okay. Let me go here. Hold on. Oh, not this yet. So I have only talked about Tesla as far as YieldMax. So I was going to talk about this one for a brief minute. MSTY. So a lot of these YieldMaxers were in Tesla last year, which I bagged on, made fun of them. They told me I'm an idiot. They all lost a shitload of money, and some of them sold Tesla. Okay. Because these people don't know what they're doing. Number one, people that buy YieldMax, you don't know what you're doing because you bought it because you bought these funds. That's all I need to know. So they all performance chase, right? So they just buy whatever pays the biggest distribution. They don't care about anything else. So Tesla did shit, was the only one. It ran them into the ground. So then they moved on. So what did they move on to? Well, guess what? Crypto. They moved on. They all became crypto investors this year. Why? If you look at MSTY, look at his performance at the beginning of this year. It was doing great because Bitcoin was flying and MicroStrategy flew higher than Bitcoin. And they're like, oh my God, Michael Saylor's a genius. Oh my God, I don't know anything about him, but whatever, to the moon. So they all started buying it. And I saw them all in the videos buying it. And I'm like, I'm like thinking in my head, I'm like, you people are psychotic. You're buying a derivative strategy on Michael Saylor. He's a psycho. They don't even know who he is. I guarantee they don't know what he's doing. And some of them I've gotten just obliterated. 40% drop. Some of them I've seen, okay, here, 33%, 23%. So these people are down 20 to 40% probably this year that bought this because they all bought it this year. I don't think it even existed. Yeah, it came out this year. So again, another example of YieldMax taking money from poor, broke people. Here you go. What's funny is none of them will tell you that they're losing money. They all say they're doing well. So they'll say they're doing well or the strategy's working for them, whatever the fuck that means. But truthfully, I can tell you, they're all losing money hand over foot. They probably haven't even factored the taxes they're going to pay. Some of them probably aren't even paying taxes. So they're probably a year or two behind in their taxes. God help them if they're not even filing. They're paying 1% fees. They're also paying probably loan interest. because they took a loan out. Then they probably took margin on top of that, which is more interest. So they have fees on fees on fees, taxes probably back delayed. Now they're losing money on the assets they're buying. These people are just getting completely destroyed. And I don't know what to say. This is what's going to happen to all of these funds. You pick high beta stock, or YieldMax picks high beta stocks that are popular, because the high beta part gives them good premium generation. And they pick the ones that are popular on YouTube. They invite YouTubers to conferences, so they're very aware of who talks about YieldMax funds. They have to for these things. So, and this is what they're doing. They're efficiently taking poor broke people's money, right? So there it is. And you're like, well, what does MicroStrategy do? Why has it gotten just obliterated with Bitcoin, but even seems to be more obliterated than, because we can look Bitcoin prices. This is another point. How many of you know, where is June here? Where's June? Well, if you're here, remember Carlos on Finance Junkies swore up and down that when the halving event on Bitcoin happened, what was going to happen? He was saying like Bitcoin was going to double after the halving. Everybody was saying this. Every idiot on YouTube was saying, well, obviously, if you cut the supply in half and there's all these people that want Bitcoin, then it's going to surge in price because I am a genius on economics. I know everything about economics because I got a D+ in high school in it. I'm a genius. Every person screamed that off a building. I'm like, okay, we'll see what happens. Everybody's saying this. Look what happened. Unsurprisingly to me, it's done pretty, like nothing but go down. It's pretty much gone down since the halving. You all thought it was going to go up because you're all such geniuses about supply and demand on crypto economic factors. Like, come on. Like, this is retarded. And then, buy Bitcoin if you want. I have not a huge problem with that, but then, so now you're going to layer Bitcoin. You're going to buy. Okay, then there's MicroStrategy, which is a leveraged Bitcoin product, basically. But then no, let's go beyond that. We're going to buy a leveraged Bitcoin product with a leveraged option strategy product. I can't even like begin to explain. There's so many layers of leverage and complexity to this product that you YieldMax people have no idea what you're doing. This is one of the most insanely convoluted, complicated products you could buy. Okay. And what is behind the mask? MicroStrategy, the company, so not MSTY. He borrows massive amounts of money to buy Bitcoin. So it's basically like, think of it like a leveraged Bitcoin, like a 4x leverage ETF of Bitcoin. It's probably even worse than that, honestly, because this is what Michael Saylor does. He takes every scrape of anything. He scratches together any equity he can, and he issues convertible notes, and he buys Bitcoin with it. That's what MicroStrategy is. So the reason the stock flew so fast this year when Bitcoin went up was because it's a leveraged version of Bitcoin. So it's going to outperform Bitcoin. What does that mean too? When Bitcoin goes down, it's going to have also way worse downside. But you people don't know this. And I can go look at let's go look at their friggin' present or their quarterly. Let's go to the balance sheets, right? Balance sheets, digital assets. Okay. So we got, is this in thousands? Okay. So 5 billion Bitcoin. If I'm reading that right. So here's their Bitcoin. Okay. Now we can go to the convertible notes. Well, you can see the debt if you want the long-term debt. It's right here. So they have 3.6 billion of long-term debt net and about 5 billion of Bitcoin. Leverage to the tits isn't even like the appropriate term here. It's worse than that. Now I can go down and actually look at, let's go to page 9. So this is what they do. They issue these convertible notes. Okay. This is what Michael Saylor does. He issues convertible debt, right? Convertible to shares or cash. And then he uses these funds to buy Bitcoin. Okay. So if Bitcoin goes down, this goes down faster. If it goes up, this goes up faster. Okay. It's a leverage version of Bitcoin, basic with no fees. So this is degenerate as hell. And then you're buying an option overlay on top of this. You think of the complexity on complexity on complexity. You don't even know what you're doing. All you wanted was a payment every month, but you bought one of the most convoluted products I've ever seen online. You're going to get your cheeks clapped on this. And you already have some of you. So do I feel sorry? I mean, they'll screw up and buy a different Coinbase is not as degenerate, but still it's going to go down. Crypto goes up and down, right? There's no backstop to crypto. It could have a crypto winter again this fall. You're all going to get a lot of these YieldMax people now have a bunch of money in Coinbase and MSTY because they've done well and they just performance chase. So this is like one of the convertible notes. So this is like one of their more recent convertible notes. Like there's some detail to it. So they issued it at a 2.25 coupon rate. Fine. What they offer it. Where was that part? I'm missing it. Give me a second. It was right here. So there's a conversion rate. So there's a set in stone conversion rate for converting these notes to shares, which works out to $2,043 per share. And these, I think the issuance goes till 2035, 32. So people are gambling on these notes too, because you could convert these to stock depending on how the performance of MicroStrategy. You could do well. So people are gambling now. Now we've added another layer of basic complexity and leverage to Michael Saylor's MicroStrategy, because the convertible notes are degenerate now because people can speculate on the price of the stock through the convertible note. And on top of that, like to draw this on a diagram for you, I can't even begin to understand why you'd buy a product like at MSTY. So you people that buy this, you are hopelessly and have no idea what you're doing. Like nobody in their right mind would buy this product. You bought it because you have no idea what you're doing. You just saw that it paid a lot per month and you thought, woo, income. But some of you got your cheeks clapped here. Like I'm looking here, a lot of people might have lost 40% on it this year. And you deserve it. This is what happens when you buy things you don't understand. So, they're going to sell this because it's dumped on them. And I already had a video I saw from Chimera's. Some guy bought 5,500 shares of MSTY at $35 and he panic sold it at like 29 or 30. So if you're in for the income, why'd you sell it? And then he said he was going to flip it and sell it and then buy it back because he could. So now he's going to eliminate the loss. So the $30,000 loss he was having, he just eliminated that from, it's a wash sale. He won't even get to recognize the loss. At least that would have helped him a bit. But to offset some of this ridiculous income, these people are just hopelessly outmatched by the markets is the sad part. And they're just going to be taken advantage of. So there's not much I can do to help them at this point. I'm there. Yell at me in the comments, but sorry, you're losing money. You're crazy to trust Michael Saylor. Is it YieldMax company who are doing the harvesting? Yes. That's the point. Like, who's doing the harvesting? And like, they all did this crash sandwich. So they're like, oh, I'm a genius. I'm going to buy the upside one and I'm going to buy the downside one. That way I always have something working for me. I'm going to make money. Like, you don't even know what, and again, it's like, they don't even understand what this does, that this hedging one, which is like a puts option strategy. And if they had bought Crash, they've got obliterated on that. And they've lost what, 20 down to $13 now. It's a bloody shame. These people, they always lose money, but they won't say they lose money is the important part. And I can show the futility of what they do. So let's look at Tesla has ripped, right? I said this in my original videos last fall. When these YieldMax funds lose money, you'll never get it back. So when the market at some point, that stock that it's pegged to drops, which they all will, and it recovers, you won't recover with it. You will permanently be damaged. And over time, given enough of those events, you're going to lose all your money. So that tactical stock idiot that's like, he makes fun of like, oh, are they all zeros? It's like, yeah, given enough time. Nobody said they were all zeros in a month, but eventually they will all fail. I don't know how long it'll take. The markets will figure that out. They will all fail. This is such a flawed strategy. When did it run? Tesla ran. It was this week though, wasn't it? I'm so out of touch. So it started. Okay, let me revise this. June 26th. Yeah, it looks better. There's probably prettier charts, but oh, you gotta total return. We don't want to friggin' piss them off. So again, it's like, like, okay, Tesla. What is the time frame? This is like 2 weeks, right? 9 days. In 9 days, Tesla has gone up 28%. You only got 12% back. So like in one of the greatest runs of this stock since like 2020, like you got barely, you didn't even get half of it. You didn't get half of it. So, but you're going to get, but then I've shown the pad, they got all the downside when Tesla was going all the way down to 140. Tesla got all that hurt. And now here comes, it revives. And I've always said, if you like Tesla, buy Tesla, right? Go for it. But this is just insanity. Like, and this is what this repeated over and over again. These cycles are what will destroy these funds. It's inevitable. And they think, oh, maybe I've got protection if I buy the ones in like for Google or Amazon because they're better companies. Like, I mean, Google and Amazon have gotten crunched in bad times too. It happens to every company. So, I mean, would I trust Google or Amazon over Tesla? I mean, probably, but I wouldn't buy any of these funds. So, poor people. I mean, dumb decisions by desperate people. And they lose. I've seen some of them lose $30,000 to $60,000 that they admit. I got kicked out of that group. One guy admitted 60,000 to me, and then the MSTY one I just told you, that's $30,000, and it's gone. And these people probably, can any of you afford to lose $30,000? I don't think that's not comfortable for anybody. But these funds are a disaster. I continue to say, anybody that promotes or talks about these funds, shame on you, and you're wrong. You're wrong in any shape or form. These funds should not be allowed to exist, and they're predatory. So, Kamirs was bragging about Tesla going up, and he's still down like $40,000 even after this latest rip. In his Bahamas videos, he's still down $40,000. So you're not getting, Tesla can keep running. He'll never get your money back. It's gone. If one of these stocks you own in these YieldMax dip, you'll never get it back. So, see, Tesla had like a 7 or 1. Oh yeah. Yeah, I know. It was like a week and a half of like every day they were up 5%. But and then they barely captured any of it. You can't fix these people. No, you can't. I wanted to put the point across about the micro. I really hope they really need to understand the MicroStrategy one is such a terrible idea. Like it's so much. It's like on the top of like the dumbest of these YieldMax funds. It's that Utley one, the high beta investing one, and the MSTY are right at the top as just so stupid. And I knew people were going to get crushed by that because Michael Saylor is a psycho. But here we are. Okay. I think there was one more thing. No. Oh, here it is. Someone, I think someone in CM posted this. It made me laugh because I'm like on a crusade against value investors. I feel at this point. Maybe it's because of Paul, mostly because of Paul, probably. But so many people wrap themselves around this blanket of being a value investor online, and I find it's such a crappy. I just think it's a shitty way to invest. I think you'd be better off like I said, a core satellite strategy where your core is low cost diversified indexes, and then you have satellites that are speculative positions that you have some sort of competency in yourself. I don't though the whole idea of just buying companies because they are cheaply valued or you think they're under their intrinsic value, right? It sounds so smart, but let putting that rubber to the road, I just think people are getting crushed by this. And when people come into investing, Warren Buffett's everywhere. Everyone's Warren Buffett's friend. So then everyone tells you to be a value investor. I've already covered value investing, like 50 set or like Warren Buffett's original value investing that he learned. That's not what YouTubers are doing. They call themselves value investors. So this comment was funny. This sub is horrible. It has destroyed the wealth of a lot of people. No offense, but you guys are some of the most, no offense to you guys, but most of the stocks recommended by you have turned out to be horrible. If anybody had bought stocks based on these recommendations, he would be deep red despite being in a raging bull market. We have people that have recommended stocks like Intel, Paramount, Warner Brothers, PayPal, Walgreens, CVS, Baba. All of them turned out to be horrible picks. You were trashing growth stocks like Palantir, while Palantir investors made a lot of money. Even at this point, many of you are still recommending PayPal and Baba. Paul, Baba is losing its market share against a bunch of competitors, and PayPal can go out of business because of Apple Pay. Thank you. Apple Pay is crushing PayPal. And people keep fighting me on this. I've posted the articles from last fall, and it's getting crushed. And nobody's saying PayPal's a zero. I'm just saying it's going to be a middling company. I think it'll just float around maybe 50, 60s for a while. Tencent and other Chinese companies have formed anti-Alibaba alliances to put Baba out of business. That's okay. He's going on a China rant here. PayPal probably go out of business because of PayPal and Square. It doesn't have a moat whatsoever. It has no moat. Its transaction fees are quite high, and there's no reason why people won't quit PayPal altogether in the near future. Pretty much. They're a desktop checkout button, not really for phones. Palantir, despite being expensive, can still, Palantir to the moon, I guess. But it was just funny. It's like, a lot of the companies that, I don't know, I'm going to call YouTube value investors. It's just, they look backwards. Okay. Like one of these companies will get crushed. It'll have bad earnings, go down 20%. They'll use their DCF model. They'll take all the 5-year info, they'll plug it in it, but they'll use the current valuation combined with the last 5 years of performance, and it might look like an appealing buy. But and they will tell you they did forward analysis. It's bullshit. I'm telling you, they don't look for the future. They trust that DCF. They don't look, okay, where's the company going? Where's the market of that company? Okay. Like what's the landscape of their business? Like there's so many things to look at more than what they do. I think it's such a poor way to invest in 2024. And I think it leads you to crappy companies that have limited growth potential. And I think it scares you away from true companies that actually could have game-changing results for you because you get scared away because of silly things like the multiple, but you don't really understand valuation in the first place. Oh, that's an expense. I hear this all the time. It's expensive. Like I've proposed to, in Capital Mindset, I've proposed 2 quality companies. And I even said in my evaluate, I'm like, these are quality companies. All right. So they're being valued at a quality valuation, but they have bright futures. And I got a lot of pushback saying they're expensive. They're expensive. And I'm like, that term is so meaningless in investing. Expensive. It doesn't add color to the conversation. If a company has a bright future with growing prospects, They have a solid plan. They should be more efficient in the future. Their growth rates are projected to accelerate. The total addressable market's increasing and only getting better. This whole mantra, it's expensive. It costs you return, and it clouds you from looking at really bright companies. And I think a lot of you, this value investing needs to die. I think it, and look at these companies that are talked about in value circles. Like, these are shitty companies. Like, Intel needs a split in half. Okay. Paramount is a fucking garbage bin of a stream service. Warner Brothers has so much debt, they can't get out of it. It's just suffocating. And nothing else matters. PayPal's a checkout button. I mean, these are archaic drugstores that don't even really need. There's no real reason they need to exist anymore. And then you buy a Chinese, and they're like, "Oh, China's flourishing, so I'm gonna buy Baba." I'm like, "Why don't you just buy an ETF of all the Chinese stocks then? If your thesis is China is going to do better, why are you taking single stock risk?" These people say such silly things. Like, okay, if your thesis is China is doing better, it's not Baba is doing better in an improving China. I just bought a triple leverage China ETF when it hit like $14 when they were at the worst of their worst in February. I basically doubled my money on it. I was trying to prove a point. It was just a clown investment, but it was an investment in all of China, right? With leverage. And I was trying to say, like, it's a better investment than what Paul was doing, because Paul was buying Baba. I'm like, why are you buying a single company? That's not your thesis is not a single company thesis. So I think these people, a lot of them suck at investing. I would love to see the returns of some of these supposed value investors that say they're crushing everyone. I don't know how you are. A lot of these companies are just such piss poor companies to buy. And they'll cite like Meta as a value play. I mean, maybe, but that's like a one-off, right? When it hit 80, that was like a unicorn event. So I think you'd be better off looking at future prospects of companies. And there's different ways, some companies need different valuations. Your DCF is not one fit all. I hate to break it to you people, but I've used different valuation metrics, free cash flow models for certain types of businesses, just for thought. But this guy I love this article. He went right at them, and it cuts deep, because some of these have really, like, Walgreens has hurt people. You know, a lot of people in value circles swore this was such a great, can't miss stock. And this is really crushed people. I mean, I know it has, right? I looked at this company for years. I'm like, it's a drugstore. It's a drugstore that made money by forcing you to walk through a convenience store to get your drugs. And then you had to walk back through the convenience store to leave. And hopefully you bought chips and soda. Like, what a shitty business model. Like, this doesn't even need to exist. There's like online drugstores now. And Mark Cuban's got a really good product. They have to fight to survive. They don't even I don't know what they're going to do to survive. I really don't. But anyways, my war on value investors will never end. I think worrying about intrinsically valuing a stock, I think, is pointless. I think you should be focused on the future prospects of the businesses you're investing in. That's what you should be worried about. Where is it going? If the company's prospects look brighter in the future, right? Okay, nobody's saying nosebleed valuations. You can do peer-to-peer valuations, see how they're valued with their peers. But if they have a bright future, then that's what you should be focused on. This was one I knew. I bought this because I saw that they had really good submarine contracts with the US government. So I looked at it and I pitched it back here when it was like 190. People were telling me it was expensive. I kept getting that. I'm like, do you understand? I'm not focused on the valuation on the fucking chart. The future prospects of this business are incredible, right? Ironclad moat, amazing contracts, and then the contracts will grow and they'll get more efficient. And this, like, look at it. Like, it's done great. But if you keep focusing on expensive, but you guys love to look for cheap stocks, but then you get scared by expensive, which I don't know. I think there's better ways to look for individual investments. I don't think it should be the whole portfolio, but this is a good way to look at like satellite holdings. And the core competency part that I like about Peter Lynch, you shouldn't be buying every stock in the world. There's no possible way you understand every business in the world. You should have businesses that you don't know anything about and you should stay the fuck out of. And people that tell you every business is just cash flows and you can DCF it, they're idiots. And these value investors will tell you that, oh, I can just plug anything into this. Okay, how's Paul done with technology investments? Paul's done crap with every technology investment he's ever plugged into his stupid software. Okay. So you should stick to your competencies. I try and stick to mine, industrial and retail for the most part. I stay away from SaaS companies. But you have to eat some humble pie. I think some people think they can understand every business invest in. I think you're opening yourself to failure more. I don't do private equity either. I just don't care to understand how private equity works because I don't think it's going to give me a return for the time to look at those things. So, and I've done just fine. JP Morgan's great research team, but there's no point of taking their words as certain either. No, I don't really look at analysts much. Well, it's funny. A lot of channels will tell you analysts are idiots, but then when they want to talk about stocks, they'll read what analysts said. I don't think have I ever like quoted an analyst? I don't think I ever have. I don't really care. I'm not quite sure where I'd even find some of them, but don't you think those are strong words? You really? Well, look at these investments. I'll read them for you again. These are the stocks that value investors have pushed. I'm in this community too. And they have Intel, Paramount, Walgreens, PayPal, Warner Brothers, CVS, and Bava. We're in one of the greatest bull markets of like my lifetime. If you followed these stocks, you got obliterated. So why do you think it's a strong term? I think these people cost you money. I think value investing destroys you. I think it's a bad way to look at stocks in 2024. And I think you'd be better off looking at the future prospects of a business. They say they do, but they don't. Their methodology is not about the future of the business. Where is it going? You spend most of your time there, I think you'll be better off. Why don't you buy Q? Gil, why don't you fucking buy QQQ? You keep bringing up all these weird investment products. Go buy QQQ, dude. Like, for God's sakes. That Forex leverage thing you told me about SPY, that's ridiculous. Like, you should just buy QQQ. And I buy SCHG. It's the same as QQQ. If you like quality companies and don't like paying for quality, I don't know what that means. But if you have a quality company, you're not going to get a cheap price. I mean, you want a quality company at like a fair price, which means you do need some downtrend, right? Because a quality company and they could sell it at a nosebleed price and you need to wait. So nobody's saying buy it at any price. I was told one of my winners was expensive at $4. It just touched $13. Strongman buys every business in the world and does way better than me. Strongman's like the Rock of Gibraltar, right? He's just unbreakable the way he invests through thick and thin. People are like, oh, look, he's trailing like the S&P 500. I'm like, but he's beating most retail investors, right? And isn't that the point? And he's going to get to the finish line retired with millions of dollars. So that's what matters. I use JPM to be honest, but it's all for PE. I mean, you like private equity, so that's fine. It's just like I open those 10 Qs and they're 400 pages. I'm like, nah, I can buy a retail company that's 50 pages. Too much reading. Oh, on that thing is wild. Yeah. I think that's it. So, you know what? I'm sure people are going to hate me for that, but it's fine. I'm a dividend guy at Core, or a dividend guy, right? At Core. I still contribute to my dividends, but it's mostly an ETF at this point. I kind of have 16 companies. I sometimes will buy more of them, but it's mostly just a big dividend ETF. You know what, Gil? You can go on timeout if you want to be a dick. I ain't got time for you. You don't get to say, you don't get to be a dick to me. Not on my own stream. I think you're the biggest friggin', I don't even, there's no words for you, Gil. The way you talk to people. Most flip-floppy weirdo. Well, he's in timeout now because he had to be mean. So I don't put up with that anymore. So anyways, that's it. Probably back to normal next week as long as my voice is back. Yeah, we'll have topics. So anyways, thanks for listening. An hour, perfect. Hopefully you got something out of the Nike part. I don't know. Anybody that bought Nike, maybe send them that part and tell them they should think about it a little bit. But other than that, Jesus. Okay. I'm going to play a video or a outro. All right. Hope everyone had a good 4th of July weekend and see you later.